Before we do that, we have Paul Tomasic, who's the head of healthcare at RBC Capital Markets, because the backdrop to all this, hearing from the CEOs about their business models, hearing from the strategy consultants around the different sub-markets, the themes, is that ultimately this conference is all really focused on where we're going to see deal flow in the next 12 to 18 months. And it's the bankers who will be advising on that and telling us what these businesses are worth. So Paul, welcome. And over to you.
Great. Thanks, Henry. And it's a pleasure to be at the conference and specifically on this panel with a great distinguished group of guests. If you turn to the next slide, just very brief background. As Henry mentioned, I run the European healthcare banking effort at RBC. I would say 2 points that of relevance. Maybe we do look at this on a global basis, and so I would suggest it's helpful to keep in mind that the clinics consolidation that we're seeing in Europe is in fact part of a broader consolidation that we are seeing in the global markets, in particular in the US, which in certain subsectors has been consolidating for many years at a more rapid pace. And then secondly, we do look at it through multiple lenses. I would highlight medical technology and the overlap with some of the consolidation that we're seeing in the clinic sector is very, very relevant, particularly in some of the subsectors like ophthalmology, fertility, and indeed the broader healthcare IT trend and its impact on the clinic's businesses. If you flip to the next slide, look, I won't dwell on it because I think it was stated very, very well by our panelists. But in a nutshell, I would say the recipe that has investors now more interested in clinics consolidation is probably best illustrated by this slide. The market drivers have been there. They're probably strengthened through COVID, particularly movements of public to private and inpatient to outpatient scope to drive EBITDA growth, whether that's inorganically or through synergies. And I think Dimitris and Dr. Hand did a particularly good job of highlighting technology as one of the drivers for that. And then in our world, I think maybe the incremental one that we are seeing is expanded exit options. I'll get to it in a couple of slides, but certainly infrastructure, long-term capital, strategics and global players, as well as, of course, the IPO markets is playing an increasing role. And if you put all of that together, we think that's lending itself to continuingly positive prospects for valuations. You know, the word of caution, of course, is that buyers are getting more sophisticated and are looking with more scrutiny at things such as run rate adjustments for some of the stories that we see. But nevertheless, we think there's a strong backdrop to valuations. If you turn to the next slide, we've highlighted some of those valuations. I would say a couple of caveats. The first is, of course, one size does not fit all. And as much as we'd like to put clinics in one bucket and talk about valuations of the healthcare services being a further driver for valuation in a way that maybe didn't happen historically as patients become more powerful in their demand for services. Next slide, you know, as bankers, if you turn to the next slide, please, as bankers, we're most often asked the question of whether we get credit for run rate adjustments. And historically, if we're honest, it's been one of the drivers of sectors, the ability to get extract valuation essentially for valuation or financial performance on the come. And not to steal a phrase from the lawyers, but I would say it depends is the answer. We do think that you can still get credit for run rate adjustments, just being extra focused on the same factors that were contextually important in the past. And so clearly faith in management teams is critical. Track record, particularly when it comes to inorganic and greenfield growth, is important. And I'd say the most important one driving value in the recent times is that last point, which is having data-backed track record to drive run rate acceptance. So very, very much focus of KPIs on activities that are being done, whether that's success rates for converting M&A or greenfield pipelines, or whether it's detailing how quickly you've ramped up a greenfield data in the way that you're presenting a business is probably becoming increasingly critical to getting run rate acceptance. If you go to the next slide, the next two slides will actually focus on just the expanding options. I wanted to spend a minute on infra and long-term capital. Obviously, we started this at RBC about 5 years ago, focusing on this group. We've seen it expand and mature in the way that they are approaching situations. And essentially at the core, this has always been a very, very good sector for them. It's basically essential services with some level of visibility and stability, operating in environments that are high barriers to entry. I think there are two additional factors that we're seeing in the environment, and I think our panelists again touched on this in their presentations. The first is in a post-COVID world, I think healthcare and clinics are arguably becoming, on a relative basis, more attractive than they were historically compared to airports and toll roads and businesses like that. And indeed, in a unique way, the COVID crisis may be giving some clinics a business a sort of unique opportunity to actually demonstrate the resiliency and the flexibility that they have in their models to deal with the crisis. You know, most of us haven't really had anything equivalent to a crisis since 2008 or 9. And many of these new buyers that come in have often asked about how the clinic sector can respond to it. And this could be actually a net positive or a driver for businesses that prove to perform well. And then secondly, I think, you know, not to be underestimated is the maturity of this buyer group. I think we've seen changes and in how they approach the sophistication, their knowledge of the subsector, and we think that's coming to fruition as evidenced by some of the deals on the right-hand side. And then finally, and I didn't plan on Dimitrios's announcement yesterday, although it does add to the slide. You know, genuinely, we see capital markets as an increasing exit opportunity for this sector. There are several reasons for this. I think firstly, it goes back to that size and that scale point. You know, following multiple rounds of private equity ownership, I think businesses are now getting to the size that allows them to consider the public markets for exits. By rule of thumb, we think businesses need to be roughly of about $500 million of value to start to think about the public markets. Ideally, you're north of $1 billion to get some liquidity in it. And many of the businesses are starting to break through those thresholds. Secondly, is that for the first time, we now have a listed peer universe of clinics businesses that perhaps we didn't have in the past. Right now, it's in different subsectors or geographies. Dimitrios is lucky enough to be in the Nordics, where there's quite a lot of services companies, healthcare companies, and particular services companies that underlie that market that start to create a peer set. There are others in Europe. You can look at Orpea and Corian in France in that sector. And we think as these green shoots in different geographies and different subsectors surface, you know, ultimately you're going to be able to create a composite index that allows institutional investors to tap a little bit more readily into it. And then finally, you know, we do think investors are trying to find different ways to play healthcare. You know, I think gone are the days where GSK and AstraZeneca are the only place to put your money in the public markets if you're an institutional investor. People like growth, they like healthcare technology, and I think it's a unique way that investors can get away from investing in some of the other subsectors, some of the other sectors that they invest in, and get a bit more healthcare exposure. And then finally, you know, I've put a conclusion slide there just to wrap up, but maybe in the interest of time, we head to the panels.
Very good. Well, thank you very much for that, Paul.